Now we're getting to our types of accounting errors. And these are just examples of them, right? Remember, this is the fourth category. We have our three changes. These are just errors. So we're just going to basically correct these, right? So changes from a non-GAAP acceptable accounting policy to an acceptable policy. If we just had cash basis financials and we shouldn't have been doing that, they should have been GAAP. Now we're going to GAAP basis, accrual basis. That's just an error, right? It's an error and we're just changing it. Obviously, calculation errors, that's a thing, right? If you just make a calculation error, you got to update it. Estimates made by the company without proper due diligence or not in good faith. So this you would think is estimate, right? Change in estimate. However, if a company just throws a bunch of darts at a board, right, and they say, okay, what's the value of our company today? Or what's the value of our assets today? That's not made in good faith or without proper due diligence. So that's an error. About not accruing or deferring expenses or revenues. I mean, that's an error. We're accrual-based accounting. You got to account for that error and update it. Improper usage of facts. That's another error. We got to change that, update that immediately. And lastly, incorrect classification. So this is a big one. Capitalizing versus expensing of costs. We'll see this in so many sections here. Make sure, if there's one thing you know in this test, I really personally want you to know, it's capitalizing versus expensing of costs. Remember, these go to the assets on the balance sheet. These go to expenses on the income statement. All right, company must correct all material errors. Pretty straightforward. If it is important to the users of the financials, then correct them, right? Maybe let those little white lies go by, right? $100 in fraud in $1 billion company, not a big deal. It records corrections of errors from prior periods as an adjustment to the beginning balance of retained earnings in the current period. These corrections are commonly known as prior period adjustments. What a revolutionary phrase. Adjustments in the prior period are prior period adjustments. I'm blown away. That is creative. When presenting comparative financial statements, the company should restate the prior statements affected by the error with the corrections. Not too complicated there, just as you would think, right? Wherever the error is displayed, just fix it. Just fix up your mess, clean up your mess.